This is Nick here for Merk Research, and I'm about to go through some highlights from my chart book on the business cycle. For background on these charts, you can see the first two videos on the business cycle, which are on the YouTube playlist, or read the framework section of the PDF version of this analysis, which is available on the Merk Research Patreon page. All right, so let's look at the U.S. leading economic indicators here. This picture still looks very positive for the U.S. economy and suggests that it's unlikely the economy will go into recession within the next 6 months. The Conference Board's index, leading economic indicators index, is higher this month relative to last month. It's at 6.2. That's up from 5.7 last month. So continuing to accelerate higher. Still positive on this picture. What would get me negative is to see this LEI index year over year go below the zero line. All right, turning now to the U.S. yield curve steepness. This is the 10-year yield minus the 3-year yield. It is positive at 46 basis points. I generally think that we're in a multi-year flattening trend, and my base case scenario is that the yield curve will go inverted, meaning that this line will go below zero before the next recession. For the most part, I view this as a binary indicator with respect to recession signaling. In other words, if it's positive, there's very little to say about it. If it's negative, that's significant, and you wouldn't want to ignore that. So my characterization on this chart is positive. What would get me negative is to see that yield curve go inverted, meaning fall below the zero line here. All right, on U.S. PMIs, both the manufacturing and services PMIs are at very strong levels, well above the 50 line, which divides expansion and contraction, and generally at or near cycle highs, which the cycle started in 2009, and at or near multi-decade highs. The latest manufacturing PMI came in at 60.8, up from the prior reading of 59.1. Taken together right now, the services and manufacturing PMIs are at the second strongest level since the services PMI data started coming out, which, as you can see on this chart, was basically back in the mid-90s. The only month that was stronger was in late 2003. So very positive on this picture. What would get me negative is seeing the manufacturing PMIs fall below the 50 level. All right, turning to the global PMIs picture. So while the U.S. PMIs are strong, the global picture is a bit less robust. So here are the global manufacturing PMIs. This basically captures the 12 largest economies in the world. And the growth backdrop is still positive. However, many readings have come down over the last 2 months. So for the month of February, there were downticks from India, China, Russia, Japan, Germany, the UK, France, Italy, and Canada, and upticks from the US, Brazil, and Australia. Having said that, they are all still above 50, so the synchronized global growth picture does continue, but it looks like we are seeing some softening in the momentum here for the global growth backdrop, something to keep an eye on, particularly with respect to India and China, which are two of the largest growth drivers. What would get me negative is to see any of China, Japan, Germany, or India PMIs fall below 50. All right, looking at the U.S. labor market picture, so this is the U.S. unemployment momentum chart. It shows the U3 unemployment rate, which is the headline unemployment rate in black there, versus its 12-month moving average in gray, and then the 10-month moving average of the labor force participation rate in blue. So the trend lower in unemployment generally continues. In the most recent jobs report, the unemployment reading came in stable at 4.1%. The 12-month moving average of the unemployment rate is currently 4.2%. The labor force participation rate, 10-month moving average, has generally been trending higher over the past couple of years. In the latest report, the labor force participation rate ticked up and came in at 63%, which is tied for a multi-year high. My characterization on this chart is still positive. What would get me negative is to see this unemployment rate move above its 12-month moving average while the blue line, which represents the labor force participation rate trend, moves lower. While we're on this chart, I'll go through the jobs report that came out last Friday. So the headline non-farm payrolls came in at 313,000. That's versus 205,000 expected, so much better than expected on the headline non-farm payrolls number. Manufacturing payrolls came in at 31,000 versus 15,000 expected. The unemployment rate was unchanged at 4.1%. That was a little bit worse than expected. The expectation was for a reading of 4.0, but I think that's largely due to the fact that the labor force participation rate unexpectedly ticked higher. It went from 62.7 to 63%. So that was a significant move higher in the labor force participation rate, which tends to make it harder for the unemployment rate to decline. But for a good reason, I would say, for a positive reason overall for the economy, if the labor force participation rate is higher. Then average hourly earnings year over year. So this is a key indicator that the market watches for inflation pressures. That came in at plus 2.6% year over year versus plus 2.8 expected and 2.9 prior. The weekly hours worked ticked higher to 34.5 hours per week versus 34.4 expected and 34.3 prior. Overall, I think this was a very strong jobs report, and given the number of jobs added suggests that there still is some slack in the labor market. All right, let's turn now to the San Francisco Fed leading U3 unemployment model. That's the gray line. It's a pretty good leading indicator for what's happening with the headline unemployment rate, which is the black line there. That's the 4.1%. So this is the replica of the San Francisco Fed model, and currently the picture looks very positive. The model indicates that the U3 unemployment rate should continue to decline. You can see that this is at a cycle low here at minus 1.29. That suggests that, to the extent that this is a leading indicator, suggests that the headline unemployment rate should continue to decline as well in the coming months. So I wouldn't be surprised to see unemployment readings come in below 4% this year. Characterization on this chart is positive. What would get me negative is to see this gray line trend higher on a year-over-year basis. All right, the household debt cycle. So this had been a data point that I was looking forward to getting an update on. The Q4 2017 number came out a couple weeks ago, and it came out positively. It showed that the percent of household debt that is current, in other words, the percentage of debt that's not in any form of delinquency, hit a new high for the cycle, and the 3-month moving average rose relative to the 6-month moving average, which is my basic framework here for tracking the household debt cycle. So currently my characterization on this is positive. What would get me negative is seeing the 3-quarter moving average break below the 6-quarter moving average. All right, then the U.S. consumer confidence picture. Both readings have ticked higher since last month, from 125.4 to 130.8, and from 95.7 to 99.7. Consumer confidence is still rising. At these elevated levels, there's some risk that consumer confidence could be overconfidence that will eventually be problematic to the extent that consumers have overly optimistic expectations about their future earnings. That could lead to some misguided consumer purchases and future belt tightening that would be a negative for the economy. My current characterization on this is neutral to positive. Neutral in the sense that to some extent this indicator can act as a sentiment or contrarian indicator at extreme levels, but positive in the sense that both of these indexes are still trending higher on a year-over-year basis. What would get me negative is to see both of these indexes start to trend lower. All right, so in summary, basically all the indicators are currently positive. Overall, the U.S. economic expansion looks set to continue over the next few months, and in general, until further notice. Specifically, the LEIs look very strong. The LEI index continues to accelerate higher. The overseas growth backdrop has softened a bit, looking at the global manufacturing PMIs there, but generally still looks positive. The household credit situation seems to still be healthy. The Q4 2017 New York Fed household credit data came out positively, with the percent of household debt that's current reaching a new cycle high. Then there's an additional point that I want to make here, which is which is that some measures suggest the economy is operating above capacity, which probably increases the recession risk over the 1 year out to 4 year out time period. Basically, operating above capacity can persist for some time, but it's generally thought to be unsustainable over the longer term. However, for the time being, in my view, based on a variety of indicators that are beyond the scope of the charts shown here, there does seem to still be slack remaining in the labor market, which suggests that the economic cycle can continue for a while longer. So to reiterate, taken together, I think the U.S. business cycle picture is still positive. On balance, it seems likely that the U.S. economic expansion will continue for at least the next few months and in general until further notice.